It's Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour. The very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, Solomon Lew reveals he spent over an hour in talks with Myer CEO Steven Cain yesterday. Our exclusive interview with the retail titan with just 10 days to go before the Myer AGM. Billed as the most exciting union leader since Paul Howes, we talked to AWU Secretary Dan Walton on the burning issues that matter to his members, and you may be surprised. And a huge day on the markets with Coles hitting the board, CEO Steven Cain, direct from the ASX, and all the market analysis from Tribeca's June Bailu. Well, let's start with the Hayne Royal Commission this afternoon, and CBA Chair Catherine Livingstone has defended her role in holding the bank's board to account over the Austrac money laundering scandal that cost the bank a cool $700 million and serious reputational damage. We also had Westpac CEO Brian Hartzer facing a grilling from Michael Hodge QC. On the agenda, the lack of consequences to remuneration following the $1 million penalty the bank paid after ASIC found it failed to make reasonable customer inquiries before increasing their credit card limits. Well, for more on what went on, of course, we've got Your Money Chief Business Reporter Leo Shanahan, who's been down there all day, joins me live at the desk. Is it just more and more exciting every day?
Well, it was a bad day for Catherine Livingstone. Remember you said yesterday that she wasn't out of the chair yet, and as would happen, it was a bad day. She was questioned initially on her lack of action in 2016 over Austrac. Now, of course, she joined the board at the beginning around the beginning of 2016, wasn't chairman until the beginning of 2017, and there were serious regulatory red flags in 2016. And she said she talked to the board about this and questioned senior executives, and yet none of this showed up in the minutes. And more on that in a second. But look, this is what Catherine Livingstone said she did as a result of the Austrac investigation and the impact she's already had on the bank.
This is the official record of the minutes of a meeting of the board of CBA at which very significant matters were discussed. If you challenged the regulatory report and were provided with assurances by management in response to that challenge, should they appear in this official record of that meeting?
So it's not possible for minutes to record every single question in a board meeting, and most of the questions are in fact very serious questions. That is the purpose of the board meeting.
Well, is that satisfactory, Ms Livingstone? CBA has a statutory obligation under the Corporations Act to keep minute books. You're aware of that?
I am.
And the minute books must record proceedings and resolutions of meetings of directors.
And in this case they do, but they don't record every single question that a director asks.
Well, do you accept that they don't record a very significant exchange that you say occurred at this meeting, but which we have no record of?
I do accept that, but I'm also aware that I'm giving evidence under oath.
Yes, and I'm asking you about the adequacy of these minutes, Ms Livingstone.
In terms of reflecting that particular exchange, no, they do not reflect that exchange, but that exchange did occur, as did many other exchanges during the meeting, which would not be reflected verbatim in the minutes.
Look, I thought that exchange was particularly interesting because really Rowena Orr was getting at her in a different way and saying actually the bank could have broken the corporations law for not appropriate minute taking, and it was quite an extraordinarily important Q&A to have missed being recorded.
Well, exactly. And she said this had become apparent to me that this was a serious issue. This was, I think, the third regulatory red flag that had come up in front of the bank on this Austrac investigation, which of course then blew up the following year when they filed in a federal court. But if that was the case, and they did, and she did question the board and senior executives on this, why wasn't it in the minutes? And I think it was a very good point. We're not talking about a small company here, we're talking about Australia's largest company, and surely if something like that had been raised, it would have been.
Well, she almost got her on both angles, because, I mean, there was, clearly she's a bit frustrated, Catherine Livingstone, saying, well, I'm perfectly aware I'm on oath, so you've got to take me at my word. And then Rowena Orr comes back and saying, well, that's all very well, but if it's such an important point, why wasn't it in the minutes? And this is a massive oversight. And we've got to remember that Catherine Livingstone is the queen of governance in Australia, isn't she, really? I mean, she is known for her fastidiousness.
And I think today, as I said, was a very bad day for her in terms of that reputation. I wouldn't say it's destroyed by any means, but it's certainly been damaged. Yeah. And look, have a look at her defence, I suppose, on the impact she's had on the bank.
The board made its decision, and I think this is important, on a number of bases. As you probably know, we had criteria against which we assessed individuals, but in relation specifically to Mr. Common, the board understood his perspective in terms of customers and his Better Customer Outcomes project. It understood what he'd been doing in that division in terms of the risk management implementation, so he understood controls. He led a team, and the team highly respected him. But the biggest issue for us, as I've said, is the way he stepped up at the time the AUSTRAC proceedings were lodged.
Well, of course, that's Catherine Livingstone defending her appointment of Matt Common, who of course has been in the stand.
Yeah.
Internal appointment. And, well, Rowena asked the logical question, saying, look, given all this scandal, given the manifold scandals, and a lot of them involving the retail banks, especially AUSTRAC, which, you know, Common was really front and centre of in those machines.
Yes.
What was the reaction? What was the thinking behind hiring him? Yeah. And she said, well, it was his reaction towards AUSTRAC. It was the way he stepped up in that situation. Whether or not that was an acceptable answer for Rowena Orr, it's hard to say. But look, the impression that I got was ultimately that she was very much on the defensive by the end of the day.
Right, okay. Well, she then left, so she doesn't have to come back again, at least. But then we have Brian Hartzer. And you've got to say, CEO of Westpac, you've got to say Westpac has probably been the most recalcitrant as far as the Royal Commission is concerned, in terms of sticking with its vertical integration model.
Yeah. I mean, if it was a poker game, Westpac would be the kind of hardest to read. And I think Hartzer definitely... you know, they've been holding the line on certain issues, more than happy to be labelled, you know, the bad cop in situations. I mean, take the BBSW scandal. Yeah. They decided to go to court. They were the only ones, and they basically won. I mean, they paid a $3 million fine and were found not to have breached a whole parts of the law. So, look, Hartzer today, once again, it was a harder nut to crack. Granted, they didn't have as much material to go on as you do at the CBA. But ultimately, it was, it's been a good performance thus far from Hartzer, I think. But have a listen to Hartzer. He was asked about financial planning, the future of financial planning, really, for the bank.
Advice is inherently a challenging issue to monitor because you're talking about a subjective conversation between two people at some point. Investing inevitably has a level of subjectivity around it. Which can mean that with the best will in the world, results don't necessarily come out the way you expect them to. The standards of documentation and proof that we're now, as a general industry, expected to meet are very, very high. And so the cost of training, hindsighting, storing documents, auditing, and the like is very, very high relative to the revenue associated with providing that advice.
Brian Hartzer there, and so he'll continue tomorrow in the stand, and we think till about lunchtime. And then Nicholas Moore, actually the highest paid banker in Australia.
Well, exactly. Right. Well, it's very interesting. Leo, thank you very much. Quite a gruelling day, as you say, for the chair of the CBA. OK, well, keep holding your breath. The war of words is escalating between Myer's chair, Gary Hansel, and the most active of activist investors in this country, Premier Investments Solomon Lew. A leak to the AFR kicked things off late last week, with Myer forced to disclose a near 5% slide in first quarter sales. Premier Investments jumped on the revelation, sending an explosive letter to Myer shareholders that urged the ousting of the entire board at the upcoming AGM, which just happens to be next week. Myer then hit back immediately, imploring shareholders to support new CEO John King and his executive team. Well, it appears that the plot is thickening. Solomon Lew, who's never been critical of the CEO, actually, only of the board, has had his own meeting with senior Myer management. I spoke with the man himself, Premier Chairman Solomon Lew, a little earlier. Solomon Lew, great to catch you in Melbourne. Now, the latest dramas around Myer, we've seen this leak on sales coming just ahead of the AGM. Do you think it's enough to convince investors to spill the board?
Well, if you think about what's transpired at Myer over the years, you've still got a director on the board that's been there since 2010, when the share price was floated at $4.10, and today it's under 40 cents. So shareholders have lost over 90% of their value. And you know, if that's not enough, you tell me what is.
Is it possible, in your view, that Myer could actually go under? Do you have a sense of the relationship between Myer and its bankers at the moment?
Well, it's unfortunate. Their sales performance, which is shown in the first quarter, is woeful. It's double the decline in the first quarter of 2017, and they were hell-bent on hiding it. How it came out was a mystery, but now that it's out, shouldn't they also release what their loss, there is no profit, what their loss is currently? Obviously, they're in serious loss and are now in controlling by the banks. The banks are controlling this particular company.
So do you think Myer is actually in danger of going under now?
Well, I think that Myer is now controlled by the banks. The banks have reduced their facilities in relation to the cost. They've doubled the cost. I estimate that the costs are now somewhere around $15 million as a result of the risk factor, and they've risen from about $7.5 million for the banking costs. So I think that there is some serious issues for the shareholders. The shareholders have basically lost their money. Those people that have been there from $4.10, they've lost their money. But now the risk is for suppliers and for employees. Will they have a job?
Now, of course, Myer has hit back. They say Premier Investments should be ashamed of the letter sent. It was misleading and hostile just ahead of the crucial Christmas period, and basically you're sabotaging.
Right. Well, could I say this? There are 48,000 shareholders and there are 25 million customers in Australia. That doesn't include the tourists. The mere fact is this, is that you've got a board that has no retail experience. I saw this week that Ownership Matters, one of the proxy advisors, advised against a new director that is being promoted onto the board, etc. And the Ownership Matters openly admits that they need retailers with retail experience. There are no retailers on that board. And if you go back in time, Mr. Hounsell said he doesn't shop. He doesn't go to the stores. And in fact, I recall the statement that he made at the AGM last year. He said he knows how to make money. At that point in time, the share price was 80 cents. Today, it's a smidgen under 40. So in 12 months, he's managed to halve the value of the company, plus give away the rights of shareholders to the banks, plus he took nearly a $500 million impairment charge.
So Gary Hounsell, the chair, or actually the board, argues to shareholders that your hostile campaign is actually a risk to them, risks of allowing a competitor into the Myer boardroom, they say, against the best interests of Myer shareholders, that Premier's web of vast and competing retail interests creates a web of unavoidable conflicts with Myer. Now, this is something that's come up before, Solomon.
Ticky, we are only one shareholder. There are 48,000 shareholders out there. If I can't tell you how many hundreds of letters that have come in to our office appealing for our involvement. And as you well recognised, and you would have seen the Financial Review today, where John Sevior has quoted that Premier is the best retail company in Australia. So, you know, that doesn't come as a surprise because we've delivered outstanding results to our shareholders. The difference is this: we know our business, the people at Myer don't. And that's why the shareholders are demanding a change. The shareholders, that's why the people that voted last year in relation to the REM report, and will vote again this year in the REM report, It's their prerogative. It's their company. It's up to them. They have lost billions of dollars, not hundreds of millions, billions of dollars, and many people are about to lose their livelihood.
So they would argue that it's not your shareholding, it's your sales as a supplier that creates that conflict of interest.
Well, I don't have a conflict of interest because I'm not on the board, I'm not intending to go on the board, and I'm not intending to take the company over. So, if you listen to Anton Tagliaferro, etc., and his sidekick, Simon Conn, they're all about selling me their holding. They came to see me in October of 2017, and all they wanted me to do was to buy them out, get them out of their problem. And by the way, they were in there at $1.65 is their average entry price, and today they've lost 75% of their money. But I suppose they don't care any longer because they've sold their company to a foreign group in France, and they're just kicking this along.
Solomon, the Myer letter, I think very specifically says that the board is recommending shareholders support John King as CEO and the Myer customer plan. Now, I'm wondering, do you disagree with that at all, or do you disagree more with Lindsay Cattermole, Dave Whittle, Gary Hounslow as directors on the board? Do you actually have a problem with John King and the Myer customer plan? No.
John King, in fact, spent an hour and a half in my office yesterday together with his new merchandise manager, Alan Winstanley. And we had a wonderful conversation. We talked about global business. We talked about business in Australia. They are two foreigners in this country that have arrived here in the last couple of months, and they need to be guided by an experienced board. They cannot be guided by an individual like Gary Hounslow, who October last year said, I see green shoots in Richard Umber's plan. I'm supporting Paul McClintock's plan. And it all failed. 2 months later, they had a downgrade in December. 4 weeks later, they had another further downgrade in January and February. And then they wrote off $500 million of shareholders' money. Plus, to add insult to injury, you've got Gary Hounslow taking himself an executive chairman's fee of $1 million pro rata, right, to take on the job, as well as all the other directorships that he has. So I guess the question is then, Solomon, why don't you actually put up an alternate board for shareholders? You've mentioned in the past a couple of retail experts and a property expert that perhaps you'd had some association with as possible directors, but also you'd look to have an independent board as well. Why don't you put up some ideas for directors on the AGM notice, and wouldn't that actually help spill the board? Well, it's far too late for that. What shareholders are doing now is they're voting in relation to the remuneration report. Once the remuneration report comes through, they'll have 90 days to call a spill motion meeting. If they don't call that meeting, well, then there's other avenues for us to be able to call a meeting and then announce our slate. We'd be happy to announce our slate once the remuneration and they call the spill meeting within 90 days. Of course, we will advise shareholders of the totally independent board with experienced retailers, with people that can make a contribution. It's no good telling us today that I've reduced my chairman's fee from $350,000 to $300,000 and directors' fees for $150,000 to $120,000 because you wouldn't feed them. You wouldn't pay these people, right? Because they have failed the shareholders. They have absolutely failed, and they have destroyed Myer. So do you think you're actually going to have success with a second strike, given the Jeff Wilsons and Anton Tagliaferros of the world? I'm sure that we will. I'm sure that the shareholders will vote in favour of a strike for the REM report. I'm absolutely convinced of that. Solomon Lew, it is always great to talk to you. Thank you very much, sir. Thank you, Ticky. After the break, the global market rout continues. We'll get some analysis from Perpetual's Head of Investment Strategy, Matt Sherwood.
You're watching Ticky on Your Money. Now, Back to Ticky.
Welcome back. Well, US President Donald Trump is optimistic about the outcome of upcoming trade talks with China, according to White House economics advisor Larry Kudlow. Mr. Kudlow says President Trump believes his Chinese counterparts are equally keen to have a deal in place and that the Chinese response to his demands are largely complete, with all but 4 or 5 big issues yet to be agreed, signalling tough decisions ahead when the US and Chinese presidents do meet at the G20 summit in Argentina. Mr. Kudlow confirming no deal would happen unless it suits American interests, with President Trump willing to impose additional tariffs on $267 billion worth of Chinese products if a deal isn't reached. Well, meantime, Australian markets in need of a US-China trade deal if there's to be a pre-Christmas rally, according to some analysis. The local market, the worst performer in the Asia-Pacific region over the past 3 months, tumbling 11%, with investor fears over global interest rates, falling oil prices and a slowing Chinese economy, adding to concerns over the ongoing trade tensions we were talking about. The Australian benchmark stock gauge hasn't fallen in the final month of the calendar year since 2011. Well, the local market closing down today around 0.5%, tracking Wall Street's sell-off overnight. The global rout continuing today with the S&P 500 and Dow Jones Industrial Average sitting at their lowest levels in months. Is the market doldrums just a sign of the times, or should we expect better days ahead? Well, for more, I spoke with Perpetual's Matt Sherwood earlier. Matt Sherwood, thank you for coming in. What do you make of these wobbly equity markets around the world?
Well, I think the key thing that investors are now questioning is really the growth outlook for last year. We've had 2 years of above-trend growth. I think growth is slowing to about a trend pace next year, so it's quite a significant slowdown. And they're worried about the impact of that, but also the Federal Reserve continuing to tighten interest rates. So I think the big thematic that's going to come out of equity markets next year is going to be margins. Revenue growth is going to slow, cost pressures are building, in all major economies, so that means lower margins, and these double-digit earnings growth that people are forecasting, I think, are seriously in question. We've
still got the global growth, though. I mean, what can we say about the returns to investors as well, and how that compares?
Yeah, that's a great question, and I think people aren't worried about the global economy per se, but they are worried about a global earnings recession. So expectations are now starting to come down about earnings growth, and I still think they've got a long way to go. So, for example, in the US, they're still thinking 10% EPS growth next year. I think it's more likely to be 3. And if
really?
And risks are to the downside with that. And so that and the fact that the Fed's still moving interest rates up, which increases your cost of capital,
yes.
Naturally that means that share prices getting hit from 3 directions: lower revenue, higher costs, and a bigger discount factor. And so we're starting to see volatility really spike.
So why are the returns not good? I mean, what you're suggesting is that we're going to get a pretty poor couple of earnings seasons ahead.
Well, I think earnings growth is going to slow progressively throughout the year. So, the next earnings season in December will still be okay. It's still probably going to be around 10%. But I think the big question is, what is it going to be in December next year? US growth at the moment is about 3.5. Now, in my numbers, growth by the end of next year in the US is going to be 1.5. And so whilst the average growth for the year still looks good, there is a massive ratcheting down of the growth dynamics. And as a result, that will naturally flow through to corporate bottom lines. And we know that wages growth in America is still going up. So to me, we're getting hit by a trifecta of factors, and none of them at this stage kind of look like breaking or ceasing, at least for the time being.
You've got some work that you've done, rather good graph on the global money supply. Now, what is that for viewers, and what sort of signals is it sending you? Well,
what this chart is, and it's from Bank of America, and it's just the real monetary base. So it's really the real growth rate in the value of notes and coin and short-term deposits. And what that chart shows, it's not really what it is that's important, it's really what it signals. Now, what we can see in that chart is that it's now just below 0. Now, for 5 other times in history since 1980, it's been below 0. And they were 1982, 1991, 1998 and 2008. Each one of them signalled a recession or a big growth slowdown. We're already starting to see the growth slow down in the lead indicators. So the OECD has lead indicators. January this year, 26 economies of the 38 were growing and had positive momentum. Now only 6 of them do.
So where does this leave the job of the central bank? I mean, the Federal Reserve is still trying to continue its mission of getting back to normal.
Yep.
Whereas Philip Lowe, for example, here is not doing that. He's regardless of some of the critiques that have come in saying this is the opportunity, we have got growth in this country, you should be putting rates up. Yep. He's not doing that. What should central bankers be doing, do you think?
Well, they probably should be playing their own game, because the Australian cycle, for example, is a bit different to the US cycle at the moment. So the Fed's trying to get rates back to neutral, and I suspect they're probably not too far from that. Probably 2 more rate hikes, 3. If they follow through on their guidance of 5, I actually think that would end up ending the cycle. So we'd have a recession in probably mid-2020.
Yes.
So I still think there's only 3 there. The RBA here is clearly on hold. And why is that? It's got 2 big tail risks for the economy. A pretty big slowdown in China, which is occurring as they try to deleverage their economy a bit.
Yes.
The other problem, of course, is domestically driven, and that's the housing sector. So the housing sector is deflating in a price sense, activity's still okay, and as long as interest rates remain at all-time lows and unemployment remains low, then we should be able to get through that.
Well, I noticed Phil Lowe, the governor,
risk.
last night was talking about, you know, we could sit at around 4.5% unemployment without seeing wages growth pick up by too much.
Yeah, I don't think that's probably wrong. And what history demonstrates conclusively is once you get your labour market through what you class that full employment level and unemployment goes even lower, it doesn't immediately signal that wages growth are about to explode to the upside. Because America, for example, has been below full employment for the past 18 months. Wages growth there is rising, but it's not threatening inflation at all, nor is it in Germany, which is in the same position, also in Japan. So in the end, in these countries, unemployment's at a 40-year low, but wages growth really isn't threatening a breakout in consumer prices. So I think the governor's right that as soon as you go through NAIRO's not a reason to be hiking rates, and we've seen that's been successful, for example, in Germany and also in Japan. And of course, with the housing situation in Australia, if they were suddenly to hike rates, you know, 1 or 2 times probably wouldn't do much, but if they did 4, I think you start to see a cascading effect in terms of the labour market, consumer spending and hence economic growth.
Meanwhile, we've got a growing difference between our 2 central banks, the US and Australia, in terms of the cash rate, don't we?
That's correct, and it's probably going to expand even more. So the Fed, to me, is clearly going to do another 2, risks of a 3rd, but I think that'll be it. I think the RBA is on hold not only this year and next year, but into 2020.
Wow. Briefly, can I just pull in your other graph that that you sent in, and that is around the different sectors and how they've performed in the US? Yeah,
that's right. And what it signals is that there hasn't been a massive rally in safe haven assets during this market sell-off. So bonds have done a little, but not a lot.
So this is October, basically.
This is post-October 3rd. The US dollar hasn't really rallied much. Gold hasn't done anything. And I think some of what's been happening has been a rotation out of expensive growth sectors, as you can see in this chart, like energy, such as IT and consumer discretionary, which had really done well in the past 2 years.
Yeah.
So their valuation just became too high and unsustainable. People are now questioning the growth outlook. Apple's now coming out and saying that, you know, they're not going to disclose how many iPhones
they're
they're
in correction
making.
territory now.
They are, and so are the, several other of the FANG stocks. So there's been a rotation out of those expensive growth into those cheap defensive sectors or the value sectors, and so there might just be a little bit of sector rotation rather than this is it, that's the cycle's end, so I'm just bailing totally out of equities.
Matt Sherwood, great to talk. Thank you.
Thanks, Ticky. Cheers.
After the break, talking pressing union issues with Daniel Walton, National Secretary of the Australian Workers' Union.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, Daniel Walton is the National Secretary of the Australian Workers' Union, Australia's oldest and largest blue-collar trade union with over 100,000 members. He's been across the table from some of the country's most senior executives, carving out industrial relations settlements that have seen him credited with helping to save the local steel industry, most importantly the 2015 BlueScope steel negotiations, which kept the manufacturer from shutting its Aussie operations. And last year, Mr Walton helped save thousands of local jobs after the sale of Arium's Whyalla Steelworks to a company owned by British billionaire Sanjeev Gupta, and we've had Sanjeev on a few times here too. Now, Daniel's also a director of Aussie Super, which is the largest industry super fund in the country. So I'm delighted to say Daniel Walton joins me now. Welcome.
Thank you for having me.
Well, so much to talk about, Dan. Let me ask you first about what it was like working specifically with business by business, you know, with BlueScope. You were there with, I think, Greg Combay, wasn't that right?
Yeah.
How did you manage to get over the line, and what sort of concessions did you have to make and compromise did you have to make on behalf of the union?
It was a difficult time, probably not the best time to get involved in the steel industry, starting around that point, but you know, we look back now and we're quite proud of the things that we did. In 2015, BlueScope set a challenge of finding about $200 million of savings.
Yeah, having only wanted much smaller amount of savings before that.
Yeah, correct. And we worked through some initiatives with them, but the board obviously set a target, 200 million in around 8 weeks. Of that, 60 million in those savings had to come from workers.
And they opened the books for you to have a look at, didn't they?
Yeah, so there was a big validation question. We got Greg Combay involved at the time to go through the books, and he basically came back to us and gave us that advice, which is this is very serious, and that if you don't get your act together, there's most likely going to be a steelworks shutting down in the Illawarra region.
So that was a one-on-one thing. You then went on and worked with Sanjeev Gupta, I know, and I think, you know, as I say, it developed quite a good reputation, you know, for being able to work with business.
Correct, yeah.
So now we've got this push from the unions more broadly for industry-wide bargaining, which I think business is quite concerned about. And if I can quote one of your co-directors on Aussie Super, Innes Willocks, who's obviously the Australian Industry Group CEO, he says the ACTU self-serving demands for an industry bargaining system in Australia need to be emphatically rejected by all political parties. The only ones who would gain from industry bargaining are the unions, which only represent 9% of workers in the private sector.
Yep.
Do you believe
I'd expect nothing else from Innes. Innes is a really good guy, and we work quite closely on a lot of detail around energy policy.
But do you believe in industry-wide bargaining? Do you think it's the right thing to do?
I think what is happening at the moment is Australia's really struggling. Australians are struggling for a pay rise. All the work that we've done with our members at the moment, people are sort of talking about really maintaining the things that they've got. It's been a long time since people talked about improving their conditions. In the likes of BlueScope, where albeit we saved the steelworks, they've had 3 years of very profitable years, and we are bogged down in negotiations trying to get a pay rise for those workers as well. And so
I guess the fear from industry's point of view is if you'd have industry-wide agreements, that would also trigger, if things went wrong, industry-wide, potentially industrial unrest, which has a potential to really shut down parts of the country.
I just don't think there's really any evidence that's really backing up any of the claims at the moment. Industrial action is absolutely at all-time lows. Lost days to industrial action are at all-time record lows.
Yes.
Wages growth is at all-time lows. There is some correlation between all of them, and I think for us it's really about trying to find a mechanism which provides some fairness as the economy changes and doesn't set in the big old, like for us we used to be big industrial sites, huge numbers. We're now small to medium-sized enterprises spread right across the board, and being able to provide some security and lifting the base for a lot of those workers who are struggling for a pay rise.
So you think you can do that without creating, you know, the risk of broader unrest?
Well, absolutely. I think, you know, there's a lot of very smart people. Sally is a very, very smart and capable woman, and there's some...
She also believes in breaking the law when justified.
Well,
which is quite scary
for business. Slightly more nuanced message than that, in fairness to Sally. But obviously at the moment it's really about trying to find an outcome which is going to provide some stimulus in the economy. The Reserve Bank has come out and encouraged it, the IMF have encouraged it. There's a lot of people talking about the need for us to improve wages.
All right. What else are you going to take to the ALP conference?
For us, ultimately, it's providing a solution around energy. We are in a strange situation where we are the people who are extracting the gas, who are drilling for gas, who are building the LNG facilities, who are building the pipelines, piping it, but also our members sit at the end of that line who need gas to power their operations. We work in heavy manufacturing in steel and aluminium, glass.
So you want a reserve? domestic reserve.
We've been calling for a gas reservation policy for a number of years now. The last ALP conference, we managed to get in place a national interest test, which was for prospective projects.
Do you think you're going to be successful? Do you think the Shorten government would agree with that?
Well, the funny thing was we were called sort of interventionists at the time. We were going to create sovereign risk, but then Malcolm Turnbull, the then Prime Minister, sort of leaped straight over the top of the Labor Party and intervened in the market with the gas security mechanism. So they've now talked about intervening in the electricity market. So what we ultimately need.
But do you think the ALP will adopt it?
Well, no, not in that exact form, but what we're hoping is to find a solution which is going to provide some security around both volume of gas and price.
OK. Coal, you're quite pro-coal, aren't you? Last time I saw you, you were actually quite even pro-Adani. Still pro-Adani?
Not so much just specifically about Adani. I've been asked a few questions about it, but coal is a major, major part of the success of our sites where our members work. We need baseload power generation and we need some security. Renewables will play a part in the future, but right now, we always use the example of the aluminium smelter up at Tomago. Yes. The world's largest battery at the moment can power it for 6 minutes. So we need significant generation to be able to...
Dispatchable power.
Correct.
OK. Now, look, another big area we're just watching the Royal Commission go through now. Yes. Really, the industry funds who have strong connections with the unions came out very positively out of the Commission, I think it's fair to say, when compared to the retail funds. However, we now have a push from people from unions, including people like the ALP Senate candidate Tony Sheldon, who want to ban for-profit super funds if elected. Now, when I was down at ASFA talking to Bill McNabb, who runs Vanguard, which is a what do you call those things? A non-for-profit anyway. Yep. And also Michael Dwyer, who ran First State Super. They are very against the idea of banning retail funds because they want more competition. Where do you sit on this?
Well, I think it's going to be really difficult for a lot of the retail funds going forward with some of the outcomes of the Royal Commission.
Did you want to ban them?
Well, whether or not they need to be banned or not, we haven't exactly expressed a view around this. I think, to be completely honest, I think they're really going to struggle to operate in the environment going forward because there's significant concerns being raised and in whose interest do they operate. But I also do take the comments from the other side in terms of having that increased competition or having some competition, albeit very failing competition at this point in time, might not be a bad thing for industry.
All right. Now, where are we with the Minister Michaelia Cash and going back to those raids and you taking the whole issue to task now? How is that case proceeding?
Yeah, so the case is now listed in February. We've now served subpoenas on Michaelia Cash and a number of her former staff members, members of the Registered Organisations Commission, and that is listed for February. It's been a really, really long process.
What do you think is going to happen?
Well, the AFP have handed all their materials off to the DPP, and I think they're making an assessment of their case at this point in time. I hate to speculate, but I think it's likely the DPP is going to refer or recommend some action against some of the individuals who have already admitted guilt. And as the AFP have said publicly a number of times, impeding an investigation.
Well, we've got Senator Cash's former Chief of Staff, Ben Davies, was served by a subpoena. Is that actually correct?
Yeah, that's correct.
Right.
Yep. So Ben Davies is a former Chief of Staff. We had sought to issue a subpoena to him. That was done last week, I believe. But in terms of Michaelia Cash, in terms of David DeGaras, her former staffers, in terms of a bunch of others, they've been served for both appearing and also production of documents, and the case is listed for February. I think it will more than likely, at this case, be before the federal election, so it'll be interesting viewing at that point.
And as far as the union is concerned, there were no documents destroyed. There was nothing to see there, going back to Bill Shorten's day when he was running the AWU.
No, I still think it's absolutely crazy that we saw the AFP. At the time, they were saying they didn't have enough resources to invest cocaine busts and drug rings, etc., that they fronted up in search of a couple of pages of documents.
All right, Daniel Walton, we're out of time, but so interesting to talk to you. Thanks very much.
Thanks for having us.
Well, after the break, coal's officially going solo today. We'll get more from CEO Steven Cain next.
Now, back to Ticky.
Yes, welcome back. Well, a demerged Coles is listed on the ASX at a price of $12.49, slightly less than the $13 to $14 mark forecast. It closed at $12.75, up around 1%. Your Money reporter Camille Bianchi sat down with Coles CEO Steven Cain shortly after the listing. Here's what he had to say.
Yeah, well, my job is not to predict what the stock price is. In fact, I've been told not to go anywhere near the stock price. But our job is to grow shareholder value over time, and we hope to do that by making life easier for our customers, and that means more convenient products, more convenient stores, and more convenient home shopping.
It's a little bit of a balancing act. You've got 500,000 shareholders. Yeah. And then you also, your colleague mentioned this morning at the listing that there's a responsibility to keep supermarket prices low too. Yeah. In the next stage of Coles, how does that happen? Yeah, well, I think it is possible to keep shareholders happy and customers happy at the same time. If you look at what's happened at Coles over the last 10 years, prices have come down, but profits have still increased in the process. It's a very different landscape in which you find yourself. So it's not only the company returning to the ASX, you're returning to Coles. So you were with Coles 14 years ago. Yes. Since 2003, there are new players. There's Aldi. Yeah. You know, you're at the helm of Metcash. Yeah. What's your biggest competition? Is it just Woolworths? No, I mean, everybody who sells food and beverages in Australia is a competitor of sorts. What we've got to do is remain focused on the customers and our own plans. We do get paranoid about competitors as well. We spend a lot of time looking at international competitors that might be entering in Australia. We obviously look at websites every day. We want to make sure that Coles is the most competitive offering in Australia. So Wesfarmers has retained a 15% stake in the new Coles business and a seat on the board. Yeah. At what point do you divorce yourself from that chapter, and is that difficult with that kind of intake, or what do they call it, a strategic alliance from Wesfarmers? Yeah. Well, the separation starts today. As we've listed on the stock market, and they've gone from being our sole shareholder to our largest shareholder. Generally, Wesfarmers are a long-term investor business. You'll have heard at the AGM last week that they're interested in long-term shareholder returns. That'll be a very similar picture to what we want to achieve here at Coles. Their director on the board, Dave Cheesewright, is a former CEO of Walmart International. I think he ran 29 countries and had almost 1 million employees. He's got a wealth of experience that he will bring to the board table, and we're delighted to have all of the new board members around us. Now, if we can go a little bit back in history, in 2010, Coles had its Down, Down, Prices Are Down campaign. That's since been slammed by farmers, and there have been a lot of controversy around the big two lowering milk prices. Yeah. In the new era of Coles, what kind of focus is there on farmers and that end of the supply chain? Yeah. I think there's been a lot of focus on milk in particular. What's really happened at Coles more broadly is that in the last 10 years, fresh food sales have risen by more than 50%. And I've had a lot of contact with farmers already who've had long-term contracts and long-term growth with farmers. Recently, we signed off in our Nurture Fund $500,000 to help one of our main cherry farmers build a roof over his cherries so that we'll have Australian cherries for longer. So overall, the picture for farmers with Coles is a good one. As far as dairy farmers is concerned, we've done two things. One is we have accepted some price increases on milk. We haven't necessarily passed those on to customers, and we've also got our drought relief fund that will see $12 million going to farmers, which we believe is more than anybody else is contributing here in Australia. On the same kind of theme, if we're talking a bit about shareholder and consumer activism, plastic bags, now, that was something that a lot of analysts didn't predict would be such a hot-button issue. Yeah. That was before your tenure at Coles in this iteration. Yeah. What's happening there? Well, whilst it was before my tenure, I was, a shopper, and I saw some of the, both myself and my wife saw some of the changes at the checkout. Clearly, for consumers, it's been one of the biggest changes since decimalisation, getting used to not having free bags at the checkout. This is happening around the world. It's been happening through Australia in more recent times, but we have seen things begin to settle down, and customers are getting used to
bringing their own bags in. The great news is for the environment that where there's far less plastic bags going into landfill or in the oceans, which is a good thing.
And for more on everything that happened today, including Coles hitting the boards, Junbei Liu from Tribeca Investment Partners joins me live from our Sydney studio. Junbei, hello there. What did you make of the Coles debut?
Oh, hello there. Look, I thought it was an incredible trading, and it did incredibly well, even though it is probably just towards the upper end of the expectations. But there was a fair bit of confusion as to how many shares were on issue, because given Wesfarmers was holding 15% of the shares of Coles, so total issued shares is, it's meant to be 15% more than previously expected. So some of the consensus forecasts were perhaps on the wrong share count. So it has traded very well, in my opinion, given it is also a very weak day, and it's a great first day for the trading of Coles.
And of course, Wesfarmers' share price dropped dramatically as a result of the split, presumably. How is the market looking at Wesfarmers now?
Look, it's interesting. Wesfarmers actually viewed a little bit more negative now, but given its exposure to Bunnings. Bunnings has been an incredible retailer over the years, but it does offer that direct exposure and pure exposure to the housing market, that renovation market. We all know the housing price has been falling, and the construction companies have been warning, tough times ahead. Bunnings is going to be quite challenging in that sort of environment. So investors are very cautious ahead of the pure trading.
Yeah, OK. Let me take you back to Coles' competitor, Woolworths. I saw Brad Banducci out and about today, I think. Where does Woolworths sit as a reaction to all of this?
Look, I think in terms of Woolworth, it's done well relative to the market, but a little bit weaker just on today. Now, Coles' fortune is very much linked to what Woolworth is trading on. People are putting on a discount of between 10 and 15% for Coles compared to Woolworth. That's purely because Coles has a big capital expenditure plan ahead of it, so it should be trading at a discount. But today, you see that discount kind of narrower than that, given the amount of shares on issue.
Now, Junbei, HealthScope, which, as we know, is being sort of looked at by all sorts of different people at the moment. They've had a bit of a sticky time with their Northern Beaches Hospital, which is just open. I understand the chief executive has actually stepped down today.
What a dramatic turn of events. Look, we all know that this transition, this North Shore, Northern Beaches Hospital is going to be very challenging given the tight time frame and then the very stringent contract that HealthScope signed with the government. But we didn't realize how tough it's been, and and how public it is. And then the resignation of the CEO is just another sign of it. But for investors, there's really not that much you could do at this point. You got two bidders on the table, but I guess somewhat does that mean it will play to the valuation of those bidders? At this point, doesn't seem to be the case, because one of the bidders clearly is interested in the property book of the hospital. So this perhaps is just a small adjustment to valuation. But yeah, it's fascinating.
Junbei, wonder if you've caught up with the BHP sort of talk today around. I think they made a bit of a presentation on their capital allocation policy. Obviously, everybody's very interested in how these big miners do use their capital.
Yeah, absolutely. Look, the miners have gone through a fair bit of cycle, and during times when things are good, investors do expect them to be returning some of those capital when there is not that much opportunities out there. Some investors argue that, if you do use your capital efficiently and return the money when you don't need it, so when you do need it and when there is opportunity, shareholders will support you. So it is always a balancing figure, a balancing act for a lot of companies, and BHP, of course, recently demonstrated that by selling their assets. So I think they're on the right track, and obviously in response to a lot of shareholder criticism, but we expect a lot of miners to be taking that into account much more seriously.
Yeah, the Royal Commission rolls on. How are you seeing the banks at the moment?
Look, it's interesting. The banks actually have outperformed quite meaningfully in the last little while during the market volatility. Look, I think Royal Commission is going to put pressure for the earnings for banks. As we have seen, the credit growth is slowing, the costs are going up, obviously a lot more reinvestment into the improvement of transparency, customer service and the like. So earnings growth is going to be tough. Banks are trading on very high dividend yield at the moment, so that means they are cheap. For the short term, investors are looking at the bank as quite defensive, a good place to hide the money. But of course, this is very much dependent upon where our economy goes, where the housing might hold up.
Yeah, okay. And of course, we've had the wobbles, haven't we, over in Wall Street. Generally, how are you seeing this rather nervous market at the moment? Because I think Apple was in correction territory, wasn't it?
Yeah, absolutely. Look, it is a wobble of what started as a correction in the tech sector, then expanded into pretty much all the risky and volatile sectors, and then having investors putting money into the defensive sectors such as Woolworth, Coles, and the banks and property trusts, for example. Right now, the investors really lack confidence for this market. They need catalysts, and the catalyst could be not so far away. We do have the trade talk that is coming up at the end of this month, and we do hope some sort of positive news for investor to hanging on to.
Yes, I'm into that. Camille Bianchi, thank you very much for all of that. Good to talk.
Thank you very much.
And that's all for the show tonight. Tomorrow night, a special chat with Michael Byrne, Toll Group CEO. I'll see you tomorrow night at 5 p.m. on free-to-air Channel 95, or tonight on Catch Up at 8 p.m. on Foxtel's Channel 604. Thanks for your company.